In the realm of financial economics, Bitcoin represents a digital asset whose existence is fundamentally dependent on technological infrastructure, whereas gold has historically served as a tangible store of value, independent of external dependencies. Bitcoin lacks physical presence and operates entirely within the framework of blockchain technology and the Internet, making its existence contingent upon the stability of digital infrastructure. In contrast, gold possesses intrinsic value, enduring through periods of conflict, economic turbulence, and geopolitical instability without reliance on external systems. Gold has long been regarded as a safe haven asset, preserving its worth irrespective of global economic conditions. Conversely, Bitcoin is highly susceptible to market sentiment, regulatory decisions, and technological factors. The valuation of Bitcoin, regardless of how high it may reach, whether in the billions or trillions, is fundamentally tied to the digital ecosystem in which it operates. Much like a financial bubble, its expansion is fueled by speculative demand, yet the possibility of a sudden collapse remains ever present. Consider a scenario where a significant disruption, such as an extended global power outage or internet failure, occurs. In such an event, Bitcoin holders would find themselves unable to access their digital assets, rendering their investment inaccessible. As long as the Internet and the broader technological landscape remain intact, Bitcoin continues to be a valuable instrument for those engaged in the digital economy. However, the moment an individual loses access to the Internet infrastructure, Bitcoin's value to them effectively becomes zero. With this understanding, let us proceed to conduct a professional comparative analysis between Bitcoin and gold, examining their respective roles within the financial system and assessing the implications of their distinct value propositions. This comparison evaluates Bitcoin and gold across critical dimensions: stability, intrinsic value, resilience to technological collapse, and behavior during global conflict. Drawing on historical precedents, market dynamics, and geopolitical trends, here's a detailed analysis. First of all, we see both in reference to stability as money and asset. We see gold has long-term stability. Gold has maintained its value for millennia, serving as a universal store of wealth. Its price movements are gradual, driven by macroeconomic factors like inflation, interest rates, and geopolitical tensions. For example, during the 2008 financial crisis, gold surged 25% as investors sought safety, while Bitcoin did not yet exist. Beside this, gold has low volatility. Annualized volatility for gold is typically less than 20%, compared to Bitcoin's 40 to 70% swings. During the COVID-19 pandemic, gold hit record highs, while Bitcoin plummeted 50% in March 2020 before recovering. And gold never downs to zero. It's impossible to touch zero value, while Bitcoin can be zero at any time. On the other hand, Bitcoin has high volatility. Bitcoin's price is highly sensitive to market sentiment, regulatory news, and technological developments. For instance, SEC crackdowns in 2023 caused 15% intraday drops, while ETF approvals in 2024 drove rallies. Emerging stability of Bitcoin. Post-2024, Bitcoin's volatility has moderated slightly due to institutional adoption. For example, MicroStrategy's $764 million BTC holdings, and ETF inflows, but it remains a speculative asset. Verdict: gold is the clear winner for stability, offering predictable returns during crises. Bitcoin's volatility makes it a riskier store of value. At number 2, we compare both as real wealth, intrinsic value versus digital scarcity. Gold is tangible asset and inflation hedge. Tangible asset. Gold's value is rooted in physical scarcity, industrial uses, e.g., electronics, and cultural significance. Central banks hold 18% of global reserves in gold, reinforcing its role as real wealth. Inflation hedge. Historically, gold preserves purchasing power. For example, an ounce of gold bought a fine suit in 1900 and still does today. While when we see Bitcoin, it is digital scarcity and speculative demand. Digital scarcity. Bitcoin's value derives from its capped supply, 21 million coins, and decentralized blockchain. While lacking physical utility, its scarcity mimics gold's finite nature. Speculative demand. Bitcoin's price hinges on adoption trends and investor sentiment. It lacks intrinsic value but is increasingly seen as digital gold due to its deflationary design. Verdict: gold's tangible properties and historical precedents make it real wealth. Bitcoin's value is speculative but gaining legitimacy as a digital alternative. At number 3, we see their survival in a technological, scientific collapse. When we see gold, we find that its physical resilience and universal acceptance. Gold requires no technology for storage or trade. In a tech collapse, its value endures through barter or direct exchange. Even in war-torn regions, e.g., Venezuela, gold retains value when fiat currencies fail. On the other hand, Bitcoin has tech dependency and fragile security. Bitcoin relies on internet access, blockchain infrastructure, and electricity. A global tech collapse would render it unusable. Fragile security. Loss of private keys or hardware wallets could erase Bitcoin holdings permanently. Verdict: gold's physicality ensures survival in tech collapses. Bitcoin's digital nature makes it vulnerable. At number 4. Consider a while if there is World War III, what will happen to gold and Bitcoin? Gold has a safe haven surge. During past conflicts, e.g., Russia-Ukraine war, gold prices spiked as investors fled to safety. Central banks stockpile gold to hedge against currency devaluation. And gold has also sanctions proof. Gold is untraceable and immune to digital sanctions, making it a refuge in geopolitical chaos. But when we see Bitcoin in this regard, Bitcoin shows mixed performance. In the Russia-Ukraine war, Bitcoin initially rallied as a sanctions workaround, e.g., Russian ruble trading volumes surged 270%, but later crashed due to liquidity crises. Bitcoin also has regulatory risks. Governments could ban Bitcoin to control capital flows during war, as seen in China, 2021, and India, 2023. Verdict: gold would likely surge as a safe haven, while Bitcoin's fate depends on infrastructure survival and regulatory tolerance. At number 5. What will be the behavior of gold and Bitcoin during war as stability and safety? When we see gold, it shows price stability and nil liquidity challenges. Gold's price rises steadily during wars, e.g., +20% after Russia's 2022 invasion, and retains value in post-conflict rebuilding. Physical gold is harder to transport across borders, but ETFs and paper gold offer alternatives. On the other hand, Bitcoin has volatility and decentralized utility. Bitcoin's price could swing wildly, spiking if used for cross-border transactions, e.g., Ukrainian refugees in 2022, or crashing if infrastructure fails. Bitcoin's borderless nature aids in circumventing sanctions, but its energy dependence, mining, makes it vulnerable to wartime disruptions. Verdict: gold is safer and more stable during war. Bitcoin offers utility but carries existential risks. Now the conclusion is, gold's millennia-long track record as a tangible, inflation-resistant asset makes it the ultimate safe haven. Bitcoin, while innovative, remains volatile and tech-dependent. Gold has stability and safety. During war, gold would thrive as a crisis hedge, whereas Bitcoin's survival hinges on infrastructure resilience and regulatory leniency. Portfolio role of gold suits conservative investors. Bitcoin appeals to risk-tolerant speculators. A balanced portfolio might include both, with gold as a stabilizer and Bitcoin for growth potential. In a world of uncertainty, gold's timeless reliability contrasts sharply with Bitcoin's revolutionary but precarious promise.